Investing in Fidelity index funds is a popular and effective way to diversify your portfolio and potentially earn long-term returns. To get started, you first need to understand what index funds are. Index funds are a type of investment that tracks a specific stock market index, such as the S&P 500, by holding a representative sample of the same securities in the same proportions. The first step to investing in Fidelity index funds is to open a Fidelity account. You can do this online or by visiting a local Fidelity investment center. Once your account is open, you can browse the various index funds offered by Fidelity. Fidelity offers a wide range of index funds that track different markets, such as U.S. stocks, international stocks, and bonds. When selecting an index fund, consider your investment goals and risk tolerance. If you are looking for long-term growth, you may want to consider a fund that tracks the S&P 500, which is a broad representation of the U.S. stock market. If you are looking for more conservative investments, you may want to consider a fund that tracks the U.S. bond market. Once you have selected an index fund, you can invest in it by transferring money from your bank account to your Fidelity account and then using that money to purchase shares of the fund. You can also set up a regular investment plan, where a fixed amount of money is transferred from your bank account to your Fidelity account at regular intervals. It is also important to understand the fees associated with Fidelity index funds. Fidelity index funds have low expense ratios, which means you will pay less in fees compared to actively managed funds. However, there may be other fees, such as trading fees, that you should be aware of. In addition to understanding the fees, it is also important to understand the tax implications of investing in Fidelity index funds. Index funds are generally tax efficient, meaning they have lower turnover rates and generate fewer capital gains distributions, which can help reduce your tax liability. To get the most out of your Fidelity index fund investment, it is also important to have a long-term perspective and to avoid making emotional decisions based on short-term market fluctuations. It is also a good idea to diversify your portfolio by investing in a range of different index funds, which can help reduce your risk and increase your potential returns. Overall, investing in Fidelity index funds can be a great way to achieve your long-term investment goals. By understanding the basics of index funds, selecting the right fund, and having a long-term perspective, you can potentially earn strong returns while minimizing your risk.